Continuing with our Outlook 2014, and joining me on the spot today is the Chief Economist for Export Development Canada. Peter Hall joins me from Ottawa today. Peter, it's great being back with you.
It's great to be with you again.
So, Peter, last time you were on in April, you really got the conversation going with your thoughts on gold.
Well, that's great news. I'm glad to hear that it was useful, and I'm certainly glad with that news to be back again.
So, Peter, as mentioned, last time we spoke, you mentioned that gold could fall in the triple-digit territory within the next 5 years, and you said that gold in the quadruple digits was really only because it was in an emergency zone. We're now speaking end of year. Are you sticking to this forecast?
Well, our stance was actually confirmed by the reaction of global markets to the mention of tapering by the Federal Reserve Board. Our logic really on a lot of commodity prices has had to do with the fact that we've had conditions of excessive liquidity inside of the marketplace. And so this has been stimulative, not just for gold and other precious metals, but also for base metals out there and some other commodities as well. So on May 22nd, when Fed Chairman Bernanke came out and hinted that some of these huge purchases were maybe going to be dialed down slightly in the marketplace, they roiled markets. And it did confirm, indeed, that when forward pricing started to affect the market for certain commodities, that this was a segment of the market that traders were now acknowledging had experienced a fair amount of excessive activity over the quantitative easing period of time. And so in the post period, it certainly just confirmed that logic was indeed well placed, and that we're in for more. We haven't actually started with the process of quantitative tightening yet, or even tapering. It's imminent, and a lot of that forward pricing is happening at the moment. But the logic of the argument is definitely in place. So we really haven't seen fit to change our outlook at all.
Do you think that with Janet Yellen now set to come in, Peter, that could change anything?
Well, it won't change the overall logic of tapering, of quantitative tightening, of the need to actually get the excessive liquidity out of the marketplace. It may change the pace at which it actually happens, but she herself does not disagree with the need to actually retract or extract this excessive liquidity from the marketplace. It's a question of when.
So now that we're on the topic of growth, Peter, what area of the world do you think will see the most growth come the new year?
Well, that's an easy one for us. As far as we're concerned, the U.S. economy is still the engine of the world economy, never really stopped ceasing being the engine of the world economy. In fact, the weakness of the world economy really speaks to the weakness of that engine over the last while. So as we see the U.S. economy gaining momentum at the moment, the leading indicators are up. There are other great signs of the U.S. economy getting back on its feet again. Well, it's resuming that positive engine story and is in fact adding momentum to the European, the Japanese economies, and will in time, and in not a whole lot of time, add momentum to emerging markets, which everybody seems to be worried about at the moment.
And when you're assessing the U.S., Peter, which economic indicator are you really looking at to gauge whether an economic recovery is in full force?
Sure. Well, we're keeping a very close eye on housing markets in the U.S. That's been our favorite leading indicator. It's been a tried and true leading indicator in the past. And so based on where that market actually goes, we will see, what kind of bellwether activity is actually happening in the U.S. But it's not just that now. We're seeing that in addition to the very large double-digit year-over-year gains in U.S. home building at the moment, a consumer that is actually picking up a fair amount of momentum. Now, the consumer has been up and down this year because of the jolts that it's received from the different government events. So at the beginning of the year, it was a fiscal cliff. At the end of March, it was sequestration. And of course, it was a government shutdown in October. And those things have really, broadsided what I believe would otherwise have been quite a robust increase in U.S. consumer spending. Having said that, it is rising quite appreciably at the moment. And this time, it's rising sustainably because it's not not coming at the expense of savings. Savings rates are still remarkably high, and consumers are picking up that momentum. So there's 70% of the U.S. economy that's actually showing really good signs of increase.
So, Peter, we know your thoughts on gold, but come 2014, do you think that there could be a metal that could surprise everyone?
Well, that's a great question to ask. Normally, copper would be one of those leading indicators of world economic activity. And that's one that really hasn't shown a conclusive leading indication at this point. Unfortunately, we believe that copper has been caught up in the maelstrom that has affected all other metals, and that is the uncertainty about what real pricing is at the moment. With the amount of excess liquidity that we've seen in the marketplace, it really isn't easy to tell what a proper landing price would be for any base metal. And so that's the one that we would look at as being the bellwether, the harbinger of a true recovery. And partway through this year, we sort of took copper's PhD in economics away from it temporarily because it just, it doesn't seem to have that predictive ability at the moment. It doesn't mean that that won't resume, but the unusual conditions that we see at the moment have sort of taken away its the veracity of the orange metal as that leading indicator at the moment. So it's these temporary conditions that we are battling. Let's face it, quantitative easing has never been done before. Quantitative tightening has certainly, by definition, never been done before. So we are in unusual times, and we do expect unusual movements in these prices to persist at least for the next year.
All right, on that note, that's all the time we have left, Peter. Thank you so much, and happy holidays.
Happy holidays to you, too. Thanks for having me back again.
And thanks for watching On the Spot. For our special Outlook 2014 edition, you can email us at newsfeedback@kitco.com or join the conversation on Twitter @Daniela Camboni. Thanks for watching.